In a world where the market seems to jump around every single day, there's this small group of companies that have done more than just survive. They've actually thrived for decades. We're talking about the Dividend Aristocrats. And in this explainer, we're going to pull back the curtain and see just how they've built such incredible financial resilience. All right, let's get into it.
So here's the big question, right? It's what every long-term investor is thinking about. When things get volatile, where do you even look for stability? Well, the answer, believe it or not, is hidden in a group of companies that have just mastered this incredibly disciplined way of doing business. It allows them to ride out pretty much any economic storm you can throw at them.
Okay, so our journey starts with a list you probably know well, the S&P 500. These are the big players in the US economy. But inside that already elite group, there's an even more exclusive club. Think of it like a financial fortress, built by companies that have passed some seriously tough tests, not just for a few years, but for decades on end.
So this is the big one. This is the core of what makes a dividend aristocrat. It's not just about, handing out a dividend. It's about increasing that dividend every single year for at least 25 years straight. I mean, just think about that for a second. The kind of consistency that takes to do that through all the recessions and market craziness we've seen, it's just an incredible signal of deep, deep financial strength.
And yeah, the rules to get into this club, they are tough. I mean, look at this. First, you have to be in the S&P 500 to even start. Then you've got that insane 25-year dividend growth streak. And on top of that, you have to meet these really strict requirements for size and how much your stock is traded. It's this powerful filter, It weeds out almost everyone and leaves only the most stable, mature, and seriously disciplined companies.
Okay, so just when you think, wow, that's exclusive, well, guess what? It gets even more exclusive. Because inside the world of the aristocrats, there's this inner circle. We're talking about the absolute royalty of corporate America.
So what's the difference? It really all comes down to the timeline. 25 years of raising your dividend, that gets you into the aristocrats club. Pretty amazing. But 50 straight years of increases, that makes you a dividend king. I mean, these are companies that have been paying their shareholders more and more for half a century. Think of everything that's happened in the last 50 years. Recessions, crashes, you name it. And they just kept going. And this table here, it just lays it out so clearly. You can see right at the top, aristocrats have to be in the S&P 500. But the real kicker, the defining difference, is that middle row, consecutive increases. It's that jump from at least 25 years all the way up to an incredible at least 50 years for the kings. That's the whole ballgame right there.
Okay, so the big question is, how? How on earth does a company manage to do this for decades without a single slip-up? Well, it's not magic. The secret is that they have absolutely mastered two really critical financial ideas. First up, and this is probably the most important one, is something called free cash flow. And look, this isn't some weird accounting trick. It's the actual, real, cold, hard cash a company has left over after it's paid for everything it needs to run and grow the business. You need a ton of this, and it has to be predictable. This stuff is literally the fuel for the dividend engine. All right, the second piece of the puzzle is the payout ratio. And the best way to think about this is like a financial safety net. It's just the percentage of the company's profits that it pays out to shareholders. The key is you want this to be low. A lower number means a bigger cushion, a bigger safety net, so that even if profits dip for a year, you can still easily pay and even raise that dividend. And this chart, it shows you exactly what a healthy setup looks like. A good payout ratio is usually somewhere below 60%. You can see here about 45% is going out as dividends, but that leaves a big chunk, 55%, to be put right back into the business for growth and safety. That discipline is everything. That reinvestment is what powers the growth for tomorrow and protects the dividend when the economy gets rocky. Okay, so we've talked about the financial mechanics, the how they can afford it. But what about the why? Why do they have such stable cash flow in the first place? Well, the secret is that they've built these incredible competitive defenses around their businesses. You might have heard them called economic moats. And these moats, they can look like a lot of different things. Sometimes it's just pure brand strength. I mean, think about Coca-Cola or Procter & Gamble. The names alone are worth a fortune. Sometimes it's just being so huge that you can make things cheaper than anyone else. That's economies of scale. And a lot of them are in what we call defensive sectors. They sell stuff we all need to buy no matter what the economy is doing, like toothpaste or medicine. All these things act like a fortress,
protecting their profits year in and year out.
Now, the superpower you get from having a strong moat is something called pricing power. It's pretty simple, really. When people love your brand or absolutely need your product, you can raise your prices to cover inflation or rising costs, and people will still buy it. And that is absolutely crucial. It's how they make sure that growing dividend is actually worth something after you account for inflation.
Okay, so the theory sounds great, right? A strong business, a moat, stable cash flow, it all makes sense. But does it actually work in the real world? Let's put it to the test and look at the numbers, especially when the markets get choppy. Yeah, this table tells you so much. You might see the S&P 500 have some great years with higher growth, sure. But look at the risk side of the equation. The aristocrats are less volatile, but here's the really important part. Look at that max annual drawdown. It's just smaller. What that means is, in a really bad year, they just don't fall as hard. And that makes a huge difference.
And this bar chart just drives that point home. It really says it all, doesn't it? When the market takes a nosedive, the aristocrats offer way better protection for your money. For a lot of people who are focused on stability, playing defense and losing less in the bad times is actually more important than trying to hit home runs in the good times.
So you might be wondering, okay, this sounds interesting. How do I actually invest in these companies? And maybe more importantly, what's the catch? Because, and let's be really clear about this, no investment strategy is perfect. There are always risks. Probably the most straightforward way for most people to get exposure to these companies is through an ETF. That's an exchange-traded fund that's specifically designed to track the Aristocrats Index. The big advantage is you get instant diversification across all of them in one shot, and it automatically handles all the buying and selling when companies join or leave the list. But, and this is a huge but, you have to remember this. Being an aristocrat is not a lifetime achievement award. It's a title that has to be earned year after year. All it takes is one mistake, one dividend cut, or even just keeping it flat, and boom, you're kicked out of the club immediately, no questions asked. And don't think this is just some theoretical risk. I mean, look at these names. Giants like AT&T and VF Corp, they used to be on this list. They were proud members of the club. But things changed. They came under pressure, and they were forced to cut their dividend. It's a really powerful reminder that even with these amazing companies, what happened in the past is never, ever a guarantee of what will happen in the future.
So after all this, what do we take away? It makes you wonder, doesn't it? Is this incredible, decades-long discipline, this unwavering promise to raise dividends through thick and thin, is that maybe the ultimate sign of a truly high-quality business? It's a pretty powerful idea, and definitely something for every long-term investor to think about.